Hi, welcome to the Property Show. I'm Jayashree Kurup. I'm editor MBTV. I have with me Kuldip Chawlla. He's the CFO of Puravankara Ltd. And this is part of our section on understanding how real estate should manage finance. And we are bringing the movers and shakers of the Indian industry to discuss with us. It's a freewheeling conversation about how real estate companies should be managing their finances and what have been the changes in the last few years. Kuldip, thank you so much for joining us. Kuldip, you've been on both sides of the table. You've been with the fund, you've been with the developer, and you've seen both sides. Help us understand today at this stage of the real estate market. What is it? What is it that developers are doing right when certain developers manage to keep afloat and many others are struggling? What is that management principle that is allowing some to survive and some not to, some to struggle?
Firstly, thank you for having me on the show. I think the issue is simply about one word, if I may say so, and that is about discipline. I think the discipline comes from both experience, you know, um, as well as what your internal DNA is, and no different from many other businesses, which are capital intensive, but give you multiple returns that go beyond just money over a period of time. Systems, processes become important. So if you just step back, and look at the last 4, 5, 6 years, or indeed you look at the last 20, 30 years, we will see that in our industry, experience, timeliness, credibility, quality, and customer centricity. Those businesses and entrepreneurs who have focused on this and have looked at, for example, real estate not just as a pure financial asset or product for the customer, they have benefited. The other dimension is that we must realize that real estate, at least in India and definitely around the world, is a very local business. And how you grow and expand, becomes very important. So for example, we've been in Mumbai, although we started as a business in Mumbai. We've had an office in Mumbai for 7 years now with a full complement team, but it's only now that we are launching a business, or our first set of projects there. So the point I'm trying to make is that, as with financial markets, time in the market is also very important, and how you work partnerships, relationships with all your stakeholders, that becomes important as well.
Kuldip, why is real estate a very different kind of business, requiring a different a kind of finance management than many other businesses in the market today?
So I think there are two parts to this. Part one is that, like I mentioned, it's a very capital intensive business. It can also become a working capital intensive business. Now, and I draw parallel to another industry, which is akin to it, namely infrastructure. So if we step back and look at both these businesses, in both businesses, you need to invest significant amounts of money fairly early on in the cycle. The dependence on government policymakers and people that are beyond your control is high. Issues related to land in both cases are significant, and depending on which sector you're in or segment you're in, the returns may come over a period of time. Of course, there are some differences between infrastructure, which is relatively more for public good, but I think, there are parallels that can be drawn in real estate as well. So the fundamental issue is around capital,
And you need short-term capital, you need long-term capital. And the fact is that this industry has been given a very high risk weightage. Do you think that risk weightage is justified? And how does the industry balance the short and long term requirements?
At the risk of being immodest, let me say this. We have tended to paint real estate with one brush. You know, now that's a little dangerous. You know, and the second aspect is that we must appreciate that the short term, long term, depends on the nature of the business you are in. You know, if you are in an industrial infrastructure type of product, right? Or if you are in a very long gestation, large township, or a 10 million square feet, campus development, you know, unless you can break this down into discrete phases, you know, the cycle becomes very long. The other part that we must appreciate is that, in real estate, very often between the time the land is acquired to the time it comes into production, that cycle of aggregation, consolidation, dealing with litigation and other issues, as well as, but not limited to, the entire process of obtaining approvals, starting with zoning changes, so on and so forth, you know, to the time that you are able to actually make it productive, can be a fairly long and sometimes painful process.
Okay. And do you think the risk weightage assigned to real estate per se, whether it is residential, commercial, retail, warehousing, logistics, I mean, there's a whole gamut of real estate.
Yeah.
Right? Is the risk weightage justified?
I think to understand that, one needs to just step back and say who is assigning the risk weightage. This risk weightage is either being assigned by regulators or indeed by the lending community.
Absolutely.
Because equity providers don't assign risk weightage per se. They take risk, in fact.
Yeah.
So be that as it may, I think we need to appreciate the role that real estate plays in the country. And again, for that, we need to break it up into two broad parts. One is the housing sector, which is the largest part of the Indian real estate economy. The second is the non-housing sector, whether it is data, warehousing, logistics, hospitality, commercial real estate, IT, so on and so forth. The second part is largely rent yielding, rent seeking, type of real estate, which is more sometimes a B2B, by and large, if I can use that phrase. The first part is a B2C. But both of them have a very significant multiplier effect. And I think that's been discussed on your show and in various forums. So I won't delve into that. But the short point that I'm trying to make is that the risk weightage has implications for the availability of money, and very importantly, for the cost at which such money is available. Now, because we tend to paint a lot of things with one brush, what happens is that you don't get access to capital, and where the access is available, it is not for the period or tenor that you want it, and indeed it is not available for things that you want. So for example, about 10 years ago or some time ago, they changed the thing saying banks can't lend for buying land, right? Even if that is for housing, or for things where we need as a development, in this country. The other aspect is that, capital availability needs to be timely, right? It needs to be the extent that it's needed. And very importantly, it has to be at an affordable cost. Now, you can't have at every stage of the project, for example, and every project having, the same risk weightage. That then determines. So, I mean, to be fair to my banking friends, their hands are tied,
So what can the regulator? Let's start with the top of the funnel. It's the regulator who has to do the policy, whether it's the RBI, the NHB, the Government of India, Finance Ministry, Housing Ministry. what does the regulator have to do to ease this? I mean, somewhere we're trying to regulate this industry into a structured, functioning industry. So what does the policymaker have to do, in your opinion?
So I think to understand that, we need to understand two sides of what is essentially the same coin,
Yeah.
which is credit and capital.
Yeah.
And I'll narrow that capital to debt because I think that's where you seem to be going. Credit is the giving of buying power,
Yeah.
right?
Yeah.
Debt, on the other hand, or capital, whether it is equity or debt, is the promise to give it back.
Yeah.
There is a subtle difference between debt and equity, an important one. In the case of debt, you have to give it back with a certain return within a certain period of time. The issue really is, and this is where the policymakers need to find the right balance, and very often history has shown, whether you look at pretty much all economies, including the Indian, that they have erred on the side of one or the other, right? But to berate the point, the choice, it's a capital structure issue, right? Now, if you do not provide credit, then you will achieve a certain level of growth. There is a compromise that you make. That compromise is both there at the individual level, at the corporate level, but also at the national level. So, since we're talking of policymakers, I will limit my points to the national level. That compromise, especially in a country like ours, at the stage of development that we're in, you know, and our stated aspirational goals, is very lopsided. And this is true not just of real estate, but of many other sectors. But on real estate, I think the issue is about the availability of long term, stable capital, right, in various forms. Specifically, I think the regulator has to make available money from banks, you know, or specialized institutions, and we have a few examples of what people like HDFC and others progressively have done for the housing mortgage industry, right? That's on the retail side, right? But even there, if you were to go to somebody who's not a salaried person, his ability to get a home loan, you know, has been tested, more often than not in the last many years in particular. But on the wholesale side, you know, if you look at it, the access to capital on a long-term stable basis, you know, and affordable is not there. What can the government do? There are three things that we need to look at. India is a capital shortage. We're in a capital shortage economy. So a large part of the capital may need to come from overseas. I think there are various measures that the government can do. Some have been done, but a lot needs to be done, to bring overseas capital so that they see a situation where they can get stable, relatively more predictable and high returns. The second is to get a lot more domestic capital, whether it is insurance, pension, and long-term money, you know, into the wholesale side. The third is to actually make housing a priority sector. Now, obviously, that goes back to the point you were making, about the risk weightage, and we will have to distinguish, you can't have, like I said, you can't have arbitrary rules that don't adjust for inflation, for example. So that's the one part, which is the availability of money. The second is the cost of it. Now, there are two or three things that the governments can do. If you were to look at housing as one sector, which is where probably the single largest amount of capital that's needed that's currently not available is there, we need to appreciate that there is a significant difference between the income return from a house versus the HRA. If we can bridge that gap through a fiscal fiat, that would be great. because at the end of the day, we need to appreciate that the banks need to make money, right? So unless the bank's cost of capital goes down, they will not be able to lend at a low rate, the risk weightage notwithstanding. So the risk weight can do X part of the problem. I think that's a significant part.
Yeah.
We can cut interest rates. If we can cut interest rates to 4, 5%, 6% on the retail side, and on the wholesale side, we can get money. So one is the availability. The second is the cost of capital. The third aspect, and that's why I said you need to get long-term stable capital, is the tenor of capital.
Okay.
See, we can't have a mismatch between the income capability of a project, which is example 6, 7, 8 years, and the availability of money, which is 2, 3, 4, 5 years. It is that mismatch, which often creates problems in the economy.
I'm going to pick up your points one by one. I'd like to spell them out.
Sure.
Let's talk about overseas money. There clearly is plenty of overseas money willing to come to the Indian market. What are the facilitations that are required and what stops them? The volume that should come has not come. More can come. What stops it?
So I think there are two parts to this. I think we need to go back 15 years in history, to 2005, when the government liberalized the access that foreign capital could have into India. I think there were two challenges that were faced. Number one, the conditions were very restrictive. You couldn't put money into ready inventory. You had lock-ins. You needed to do development, so on and so forth. There were minimum sizes, so on and so forth. The second challenge that we faced was that the experience of that capital was poor. And I think as a nation, we need to give capital confidence. The second wave of capital, therefore, that came, said, I want lower risk, more predictable returns. And that capital went to the second category of things that we talked about, largely commercial and office real estate, but also some of the other sectors. I think we need to do three things. Number one, we need to give adequate fiscal tax breaks, that go beyond, what we currently have. But B, very importantly, there are issues of withholding taxes, right? There is issue of ease of doing business. There is issue of moving money in and out that we need to address, right? The third thing that we need to do, and I think, that is of the industry needs to provide a platform for overseas capital to make, better returns. For that, I think the government needs to reduce, the inherent taxes that this industry pays. For example, GST, you don't have, pass through. That was withdrawn. That increases the tax incidence. The customer will pay what the market things, but the profitability of the sector is impacted by 3 or 4 things. One is the cost of land. The second is the time of that approval stake, because there's a holding cost. And the third is the incidence of taxes.
And today you pay about, if you take 100 rupees that you pay for real estate, about 30 rupees is taxes.
More than 30, about 34, 35 rupees ends up in taxes.
Right. How much of it is center, state, city levels?
I think bulk of it is between the center and the state. I don't think the city level taxes are significant.
Stamp duty registration.
Yeah, so that's why I'm saying the stamp duty registration cost, and that is the other point I think you're making, which is a very interesting and important point, which is that at least for example, the next 1-2 years, you can have a graded structure which says, if you buy a property until March 21, right? Or if you register it until March 21, you will have a reduction, example, from, let's say, current levels of 8%, you'll go down to 4%. If you did it by March 22, it goes to 6%. And by March 23, we go back to 8%, example, The other thing to look at is that, you know, we must appreciate 8% of zero is zero, right? And this is a very binary thing. You know, there's a direct correlation because, two things will happen. Imagine I were to say March 21, a large part of the ready inventory, imagine a 4% reduction,
Yeah.
On ready inventory. That's sizable.
Yeah. Yeah.
That's sizable.
Yeah. Absolutely. Now, this is as far as the availability, the management of the fund goes, the capital goes. But the fact is that the government did provide liquidity to the system. The RBI provided liquidity. That liquidity, they don't mind holding it at 2.5%, 3% with the RBI bonds rather than lend it out to the industry, right? There has to be that risk-taking appetite in the lender as well, right? Today the lender, while there is a definite push towards lending, the individual lender, the banker on the ground, is still a scared individual, right?
So you've hit the nail on the head. Fear is driving decision making.
Yes.
There was a time when it was fear of missing out,
Yeah.
where you had irrational exuberance. That's why I said, a lot of us, we tend to swing on different ends of the pendulum. There was a time when lenders, were chasing people to take money. Today, even, well established, organized entrepreneurs and businesses, are unable to access capital, let alone get the cost of capital right. So I think the first order of magnitude, and the first order of business is to get fear out of the way. You know, the second thing, so, the point I'm trying to make is that unless lenders come forth, in India at this stage, we will lose out. There is opportunity. Let me just step back and say, barring perhaps retail, okay, and hospitality in the short term, and to a very small extent, IT and office spaces in the short term, a large part of the Indian real estate industry has not seen any structural shift or structural damage.
Right. That's a big
Now,
statement to make.
now, no, that is a fact.
Yeah.
So if you, and I'm happy to kind of disaggregate this.
Yeah.
Warehousing, logistics, data centers, big beneficiaries.
Right.
I think each of us as individuals, we owe it as citizens and as corporations and as a nation and policymakers. We need to look at how can we use the force of COVID to our advantage, right? Real estate is a domestic industry. As a nation, we are fortunate that a very tiny percentage of our debt is denominated in foreign currency, right? So I think that is where, we are fortunate. Now, if you look at housing, we have seen in our own business, we did 3 new launches in 1 month, right? We had our digital platform up and running. We have done more sales during this period, and normalcy is beginning to return. The labor situation and the construction notwithstanding, the short point I'm trying to make is that housing, there is no structural change. Office benefits from de-densification, right? And a couple of other things, data centers, warehousing, logistics benefit. There is enough data to show that markets in Asia, hospitality will bounce back. In fact, I'm aware of people who are actually looking at distressed hospitality to come in and put capital in. Retail, yes, things move to online. Business models will change. We need to adapt. If we need to adapt, we need our lenders and capital providers to give us that thing. And like I said, we tend to paint everybody with one brush. So that balance, is very important.
So to bring financial stability and to take that fear out of the lender, does financial closure of a project, even when you're starting or at various stages of the project? How important is that?
Oh, it's absolutely critical, you know. But I think we need to get financial closure, you know. We need to understand that. And I think to do that, let me just step back and look and say that we can achieve financial closure in two ways. One, in theory, I can sell everything on day one.
Yeah.
In reality, that doesn't happen,
Yes.
right? So I think what is important is that based on track record, you know, based on execution experience, based on similar, I mean, if businesses, if we've survived, for example, the last 4, 5, 6 decades in real estate in India, there are many such companies. If you look at the top 10, 15 companies in each micro market or in each market, you will find at least 10 people who've been around for at least 30, 40 years, if not longer, right?
Sure.
And I think even 20 years is good enough. We've seen 3, 4 cycles during that. Cycles have become shorter. So the short point I'm trying to make is that everybody wants to finance late stage financing and give you money in the high teens, right? The fact of the matter is we don't need money at that stage. For example, we tend to sell in the first couple of quarters, we'll sell 60, 70% of what we launch. Within the first year or so, we sell 60% of the entire project. I'm talking of housing, for example, right? So we just need that small sliver of debt, to give us the confidence that should we need it, it's there. That's part one. Now, if just 30 seconds. Now that's on the housing side.
Yeah.
On the non-housing side, I do need money for financial closure.
Yeah.
We need construction capital
Yeah.
for all of the other businesses. Now, fair enough, we should have enough skin in the game, we should have enough equity.
Yeah.
But that is where we need, and it's secured. Somebody asked me once, he said, what is the risk of customer not paying money? I said, listen, there is no such thing as a bad debt in real estate. I have the house.
Yeah, right. Absolutely. But if you look at the time when the equity, private equity funds were coming in, and there was a lot of euphoria in the market. After that first euphoria, and when the market actually came down with a bang, we did see that the equity lenders were very unhappy. They felt that there has not been a process that's followed. So while on the face of it, the real estate market did not do well, in reality, the developers, individuals were not poorer. What had happened was that some made money, the equity funds did not make money, as much money as they should have. What went wrong?
So I think we need to segregate this and break it up into 2 or 3 parts.
Yeah.
As with any portfolio, there are some bad eggs,
Yeah.
right? So yes, there were some developers who made money at the cost of the equity investor, right?
Sure. Sure.
The question is, were they representative of the entire set? Were they a large part of the entire set? The answer is no. Okay. The second set, is that we must also appreciate, and having been in the industry, I can tell you this, that there was irrational exuberance and greed even on the part of the equity investors. And we need to appreciate that they took equity risk, right? So long as there's no governance problem, so long as the project didn't do well and therefore they didn't make money, that's nature of the beast, right? So that's the second set, which is different from the first set, right? Where the third part is that I think very few, I think we need to also appreciate that capital will earn a return based on the risk it takes, right? If money is coming into a project when all approvals are in place, when it is launched, then you can't expect it to make 20, 25%, returns for long periods of time. There's not that much money in businesses, right? So I think, therefore, you need to look at this whole thing from that perspective. The last part I will say is that the first set of monies that came in, very few of those deals got done with good people. or good developers or experienced developers. I think we also need to appreciate that both sides, you know, need to see what the equity fund is providing. So if I can draw a parallel to the private equity non-real estate industry, which I've had in the early part of my career the privilege of operating in, there is a significant value add that the investor brings to the business and therefore earns.
Yeah.
So the risk reward needs to be understood. That said, I think today there is a phenomenal opportunity for equity capital to come and make the returns because of three reasons, right? Number one is cyclical. Number two, because of the shortage of capital, this capital, has the prospect of making, better returns because organized developers are today seeking equity, right? And the third is that I think India needs that capital for growth because domestic capital, is not available.
A lot of the equity funds that came into India did actually started doing structured debt, right?
Yes.
It wasn't functioning as equity capital at all. Like everyone's erring on the side of caution. The bank is erring on the side of caution. The equity funds are erring on the side of caution. Is that good for the industry?
No, it's terrible for the industry. Right. So I think, what happened was that the provider of capital, so I think three things happened. Number one, they felt they needed to make better returns. They felt debt would give them those returns. The fact of the matter is that, nobody will pay you preferred returns of that nature for long periods of time. So most people who took that money took it for short periods of time, 1 year, 1.5 years, in some cases, 2 years, right? That doesn't achieve the goal. Because then you can't do development. Then it's not risk capital. Right? I think there is a mismatch there, and that was only halfway house. It was equity disguised as debt.
Yes, absolutely.
And I think that's not what this industry needs, number one. Number two, if you look at the history, the top 8-10 developers in every market did not take this money, and even today are not taking this money.
Kuldip, let's go down to one group, any group. Let's call it A. Developer A has a land bank, has a user base, and needs money to develop. Let's take the last 5 years and see that how developer A should have managed his finances so that even through COVID, he would have been able to come out strong.
Okay, for this, we need to kind of break it into two examples. Number one is where the developer owned the land.
Yes.
Unless you want to look at a new acquisition. I'm happy to look at either.
Okay.
The second one or the first one? Or both?
Or both.
Okay. So
they have in the market.
Yeah, fair enough. Where the land was historic, I think the critical issue is that over the last 5 years, the ones who've been successful have actually said, let us look at land as working capital. Let us not hold it. Let us put it into production. So the sooner you can get approvals and get that land into production, i.e. monetize that, the sooner you will release capital. Having said that, depending on what the end use of land is, whether residential or non-residential, based on that, you needed to have done speedy execution, time to market, and basically ensuring that, the cycle of capital is turned faster. Those developers that have done this, are today placed in a much better position because whether they had debt on that land or whether they had taken a small amount of working capital debt for the project or whether they had other debt, this land, which gave them a surplus, has enabled them to reduce the debt, indeed prepay it, as many of us have, and this unforeseen crisis, you are in a relatively better and more resilient position. For those, so I'll move to the second example. For those that were looking to acquire new land, there were two approaches. One is you do a partnership with the landowner. The second is you acquire that land. There is no right answer to one or the other, but the fact and the principle of what we talked of earlier remains. Do not buy land, do not buy it with a lot of debt, and then not develop it. So nothing wrong with buying. See, the whole issue of debt is sometimes misunderstood. The issue of debt is a little bit like a monopoly game, if I may draw that parallel.
Yeah.
In monopoly, you start with money. As the game progresses, you buy properties and your cash becomes lower. As you move in the game and you land on a property with the houses, hotels, so on and so forth, you have to pay rent. Your cash reduces further. So in a virtuous cycle, and people who know how to play the game will find the right balance between liquidity, right, or near-term money or cash, and property, which I'm saying is land or under construction, right? If you take a little bit of this thing and you put that property to the bank and borrow against it, the balance needs to be between what you pay and what you earn. And if I can simplify this, whether you look at the first example or the second that we talked about, which is buying land, or monetizing of existing land versus doing a new deal, I think so long as you are not borrowing too much into the future, you should be okay. In other words, if you are not borrowing to service interest, and in the financing language, we call it free cash flow, I think you should be good. So to conclude on the second example, whether you bought land, you did a joint development or profit share or whatever, I think the critical issue is turning capital around.
A lot of developers spent the money excess that they had buying more land. And in the past so many years, we saw that the land banks, they're very asset rich, which is why many of the projects are cash flow positive, because there is more juice in the project as undeveloped land or unsold units and so on. But the management of that actual capital has been very poor. Debts have ballooned. It hasn't been serviced very well. They're asking for restructuring. What went wrong?
Lack of discipline, which we talked about earlier in the early part of our show, and the discipline of capital allocation. I think that is the single most important thing that I spend most of my time on. The discipline of how you allocate capital becomes very important, because you have a portfolio, right? You've got some near-term money. You may have some ready assets where the cost is all incurred, right? You have some under construction, and then you have, like you rightly said, land. Now, if your land is at historical prices, if your debt that you have is serviceable with the first two categories, right? I think, you are far safer than if you had a lot of land now, which was funded either by debt or was at a relatively higher cost, because prices haven't moved on land dramatically in the last 4 or 5 years in particular. So I think in summary, it is that discipline of capital allocation. Sometimes you need to make hard decisions, and it's very easy for me to say it. In actual practice, it's very difficult, because you're dealing with a large number of stakeholders and a large number of issues. simultaneously. So, but if you've been able to do that, I think you're okay.
Has RERA helped?
Of course. So I think if you look at it from from the point of view of this thing, first RERA, then GST, and then the NBFC financial crisis have actually helped and accelerated two things. One, consolidation. So for example, if you look at it, this till 2017-18, the top 10 developers in the top 8 or 9 cities accounted for about 6-7% of total market share. In 2020, that number went to 14%. I expect next year it will go to 20% or more, right? So the first thing is consolidation. The second thing, and I think that's great for the industry, is that landowners who had become developers, or other things, whether they were stockbrokers or aggregators who had become developers, have realized saying, listen, I know what I'm good at. Let me focus on that. Now, in the short term, that meant that some projects were left incomplete. I think with Swami and things like that, we're getting around to solving that problem. A lot of organized developers are actually now helping solve that problem, even without Swami. You know, so what did that mean is that you then have a set of developers who understand the customer, who understand the complete life cycle, who have innovated the product, who are using technology, who are then much more credible, reliable, and the overall industry benefits. So that discipline, has been enabled by RERA, and the subsequent events.
Has it started percolating down to all levels of developers? I'm not talking about the top 20 alone. I think that fiscal discipline has to be all the way down if this industry has to come out of the mess.
Let me put it this way. I think this crisis, on top of the three that we just talked about, RERA, GST, and the NBFC, will only accelerate that process, right? And to my mind, it is happening already. We are seeing a large number of land aggregators saying, we will come to you once we have aggregated the land. We are seeing landowners say, we will address all the litigation and issues and come to you with land.
Yeah.
We are seeing brokers saying, listen, we understand the customer, we're done with our greed and our wish to be seen as a developer. We're going back to doing what we are seeing best. Just to give you a data point, 11 out of the 12 transactions that we have done in West India are with developers.
Okay.
The one that we've bought the land. So and these are transactions we've done over the last 3 years. Some of which are launched, some of which are about to be launched. So the point I'm just giving you a data point. And if you look at many of our peers, I think the situation is not different. So it is those developers, landowners, brokers, so on and so forth. We've even seen private equity funds, and capital providers who became developers, who are saying, listen, we know that discipline of capital allocation. Let's be a co-developer, right? Because they don't have the ability to get approvals, right?
Yeah. And two small queries more, and I think we've overshot our time, but I wouldn't like to close. I think there's a little more left.
Sure.
One is that there's 100% FDI in completed real estate projects. How will this initiative help the sector?
Tremendously. I think we've not seen the fine print yet, but I'm hoping it will come out soon.
Yeah.
I think we need to step back and look at it from 2 points of view.
Yeah.
Number one, that this will help the developers, to find a capital source that will help liquidate the inventory.
Yeah.
But I think the bigger benefit, if you ask me, is or the equal benefit is for the current lenders and capital providers of that inventory, because it will free up their capital, which hopefully then can be lent to the industry for other projects, because we need to increase the size of the pie, right? But I think we need to be careful about this, because I've seen in the past that some of these funds are saying, I want to buy at a 30% discount. I don't know if there is that much margin, you know.
What about REITs? Will REITs change the market?
Of course they will.
Very early, and we've got only two. But do you see this happening in other segments of real estate as well? And how soon do you think this REITs as a segment will grow?
Let me take you back 2 years to a seminar that I was on, and I was chatting with Mr. Niranjan Hirandandani. And he said, Kuldeep, my wish and prayer is only one, that the first one or two REITs should become successful, right? Today, I'm thrilled that, we've gotten there. At a personal level, it was very, very distressing, when we found, in 2010, I was talking and Pakistan already had a REIT, and India did not, right? But I think on a more fundamental level, not only will you see more REITs come forward because it frees up capital, for all the stakeholders, it also gives, the Indian customer and other providers, whether HNIs, family offices, institutions, the ability to participate and get greater confidence in Indian real estate. But I do expect, and it might take a little bit of time, for you to see REITs in other segments, right? Which is data centers, hospitals, I'm hoping, because I think there is a consolidation opportunity there, indeed in education, because there is a predictable format there. And I'm aware of a couple of private equity funds who have created private REITs that will eventually come to the market. But one really hopes that the housing rental market, may not be a REIT, but the housing rental market kind of takes off. And for that, I think the government needs to really do a lot of work, because I don't think there is enough alignment of interest with the private sector. And, public sector, we will unfortunately not be able to do. So we need to find the right format of PPP in that. But to answer your question in one sentence, yes, I do expect that trend to accelerate.
And Kuldeep, I think our conversations have only just begun. You briefly touched upon rental. We are going to come back to Kuldip Chawlla, because we are going to ask him about the rental market. And I want to do a whole show around the rental market. We've only barely scratched the surface, but there's so much potential in that market, whether it is at the base of the pyramid with the affordable rental housing format, or whether it is in the middle segment where rental housing needs to find its feet. You have to balance between between the owner and the tenant. But we'll come back to you for that. But today, I think, thank you so much for clarifying it. This was not I was not dissecting the industry. I was trying to figure out whether there's hope, light at the end of the tunnel. And you certainly seem to expect it. Thank you so much for joining us.
Thank you. Pleasure's been mine.